did that the other day, but I don't remember what it was.
Well, yeah, it's there.
Somewhere.
I know one time I looked for it, it was there, next time it was not in the same place, so you found it? Okay, where'd you find it at? Huh?
Email.
In an email? That'll help. Okay, this class is 11 o'clock. So our exam is 10 o'clock. When? Trying to see when now. Really it's on Tuesday, isn't it? Tuesday. Okay, thanks. All right, this is 11 o'clock on Tuesday or Thursday. Your exam's gonna be what time, Kayla, on Tuesday? 10 o'clock, 1 hour early. Okay, now, you can have as much time as you want. It's all multiple choice test. There's a lot of problems on it, so let me get a copy of the test, just give you a hint. Okay, from the last chapter, what page did I say you could have with you from that chapter? What page?
743.
The page of ratios. Have your own page, has copied, handwritten, what you're gonna do. Our copier down here in student lobby, there's no code or key to it anymore, just go down there and copy it. Okay? There's no excuse not to. All right? You can see the first thing I put on the test is balance sheets and income statement. All right, now from that, you're going to do what we were practicing some the other day, and we'll finish today. From that is ratios. Gross margin, earnings per share, price earnings, dividend payout, return on assets, return on equity, working capital, current ratio, book value per share, a whole darn lot of ratios. That's why I'm saying you can have that page. Okay? All right, that's the first 10. Now, the next sheet I gave you on the test compares your balance sheets. Okay? So now you're gonna have a bunch of cash flow questions from that balance sheet. Cash flow. You don't have to do a cash flow statement, but you better know how to do it. The first one is the net amount provided by financing for the year is how much? You got 4 choices. So you gotta know how to get your financing on the cash flow, or your investing, or your operating. Free cash flow. I didn't go over that too much, so please look up free cash flow. We'll look it up today if we have time. Free cash flow's on here 2 or 3 times. We better look it up. Okay. Now, I'll give you another balance sheet. And a beginning and ending balance. Here, I'm asking you how much cash is provided from operating activities, how much cash is provided from investing activities. So you gotta know your cash flow. You gotta know your ratios. I gave you another balance sheet, and you gotta calculate operating, investing, and financing activity. So you better know that cash flow. It's going to be about 2 or 3 times. Now, the rest of your test is on variances for materials and labor and overhead. Okay? All right, the materials quantity variance, materials price variance, the labor variances, the efficiency variance. Labor rate variance, I'm sure, okay, verbal overhead variance. So folks, that brings you up to just 33 questions. 3 apiece. I'll give you one. 3 times 33 is 99. I'll give you one. Okay. So you know what's on the test, and you know I'm going to drop 1 out of 4. And some of you know you made a bad grade on at least 1. Okay. So save that one to drop. I do not drop the exam grade. I drop a test grade, 1 out of 3. I will keep this one even if it's 0. I won't drop it. That would be stupid on my part to say, hey, I can drop the exam. So if you made an A on test 1, 2, 3, you don't have to learn nothing about cash flow and ratios and variances and get a 0. I don't do that. I don't drop the exam, which is the 4th test really. Okay. Now, let's go to your textbook and let's go back to cash flow right away. Somebody find what page free cash flow is on. What chapter was your cash flow? 9? Standard cost was 10.
702.
Page what?
702.
So that cash flow was chapter 14? Chapter 14?
Yes, sir.
All right. I don't know if we got to finish everything we wanted to on 14, but this is one class I didn't feel too pressured for time. I definitely had to cover a whole chapter on principles in 1 day on depreciation. And it's hard to cover it all in 1 day. Selling a fixed asset or disposing of, I had to skip the appendix on trading in a fixed asset, but don't like to leave much out either. So look at page 702. It says free cash flow, don't it? Okay. Now, I don't know how much we work with it. I'm sure you had that in one of your problems. Free cash flow is equal to net cash provided by operating activities. Cash from operating activities minus what? Capital expenditures and minus dividends. All right, you can have that formula written down, okay? To get cash from operating activities and capital expenditures and then dividends. I'd really like to look at a problem that had that question in it. bring that up and show it to you. I'm trying to find a problem with free cash flow in it. I don't see a problem that I can bring up real quick, and I don't have time to dig into it. So best thing I can suggest to you is be able to find operating activities, which we practice, and you know what dividends are paid out. Now, do you know what capital expenditures are? What's capital expenditures? It's what you pay out for fixed assets. It's what you pay out for fixed assets. Okay. So if you go back and look at page 702 that Mark pointed out to you, since there's a couple of questions on there, I don't want you to miss them. Free cash flow is a measure used by managers to look at the relationship among three numbers. All right, net cash provided by operating activities, additions to property, plant, and equipment. That is your capital expenditures. All right, and then your dividends. Free cash flow measures a company's ability to fund its capital expenditures for property, plant, and equipment, and its cash dividends from its net operating activities. The equation is given. Using the equation on this one, an example in your book, 259 for operating, 138 for capital expenditure, 28 for dividends. That leaves you 93. The interpretation of free cash flow is straightforward. A positive number indicates that the company generated enough cash from operating to pay all of its dividends, capital expenditures, and have cash left over. So that's all I'm going to say about it. Now, did I say you could have at least one page of notes in addition to the ratios, right? Okay. Okay, so let's get on with chapter 15, and we'll wrap it up today. Now, I gave you a pretty long problem on chapter 15. Now, that's all the ratios in the chapter. Now, did I say you needed to have it today or on exam day? Who has it today? 3.
You said you were going to take that 14.7 for a bonus.
Now, 14.7, y'all take that today, but I'll take chapter 15 then on exam day. Everybody got 14.7? Is that a cash flow statement? We got a new student today, Anthony. How are you? Always ahead, Anna. Okay, now that's the bonus. Now I will wait till next week, and I'll have you add on to your Scantron points for attendance, or points for registration, or points from all these bonuses. Okay. This one I'm not going to take time to go over it either. It's just cash flow, and anyhow, that'll help you for the exam if you're working. Now, what problem did I give you on chapter 15 for a bonus? What problem was it?
15.
All right, now that will be due on the exam day also. It should be just homework, but this late in the game, we'll count it as a bonus. Yeah, 15-15, the whole ratio bonus. Okay, now on this chapter, we talked about common size statements. Now, what was a common size statement? And in your textbook, we looked at those and we even practiced a little bit. Now, if you look at the first of the chapter, look at page 727 for example. Why is that called a common size statement? You are comparing what? You're comparing the change in cash from one year to the next year. Now this one we would call horizontal. They call it trend. Okay? And you'd have to divide by the base year. Now on page 728, that looks like, well, that's the income statement, still horizontal. Okay, but if you look on page 730, that's vertical. You can do a balance sheet or income statement vertical. Now that's changing everything into a percent. Now if you look at page 730, how do we get to 3.8%, Mommy? How do we get to 3.8% for this year? For anybody, how do you get 3.8%? What do you think? We did that a couple days ago. Anybody got to 3.8% yet? All right, everybody put in their calculator 1,200 cash. Divide that by the total assets of 31,500. Divide by 31,500. Now what percent did that give? 3.8. Total assets is 100%. And each one of those assets is a particular percent. Now we were comparing this year to last year in percentage form. Which asset changed the most in percents? What asset probably changed the most in percentage-wise? Cash was one, and everything else was, well, let's see. Accounts receivable went up. You must have more lenient credit policy. And building and equipment went down. 29 to 38. That could be a whole lot due to depreciation, or you sold some part. But all I'm saying, you can look at percents and see things that you can't in dollars. Look down at the liabilities. Liabilities went up, accounts payable from 13 to 18. You're not paying your accounts payable real good either. Going on down, I guess the big one here, total equity stayed the same. Total liabilities went up a percent or two. So that's what we're looking at, okay? And the same thing on an income statement. Now look at page 731. Now I want you all to calculate the 69.2% this year, cost of goods sold. 69.2. Take a minute and calculate that. How do you get to 69.2? Cody? Cody?
Yeah.
How did you get 69.2?
See, I keep on. I've done the sales and total selling administrative expenses, but I think it's wrong.
Okay, now sales here is 100%. It's like assets, total assets was 100%. So you take sales for this year of 52,000 and divide into 36,000. Divide 62 into 36, and you should get 69.2. Is that correct? So you need to know how to do a common size statement, even though your exam is all multiple choice. You'll have questions. Now that brought us up to ratios. And I didn't do these in this order yesterday or Tuesday. Your first three ratios were called liquidity ratios. Your working capital, your current ratio, and your acid test ratio are all liquidity. Now we'll practice those in a moment, but they're on page 732. Now your activity ratios, activity means something has to happen or days or whatever. It's your accounts receivable turnover, inventory turnover, and your operating cycle. All right. Now on page 733, your accounts receivable turnover here, your formula is, once again, you can have that page with you, but you bring your own page. You don't borrow anybody's page, and nobody's going to make an extra page for you. I've just seen that too many times. A student, 2 or 3 students, depends on everybody else to take care of. We're not going to do that. You depend on yourself. Okay? I had principal students for a whole half a semester. They depended on other students for paper and pencil and share the book. Depend on yourself. But anyway, the accounts receivable turnover here is 10.4. I told you to divide that into 365. Now, if you divide 10.4 into 365, what does that give you? Somebody go ahead and use your calculator. It won't make me mad.
35.1.
All right, is that 35? And they probably got the answer here in the book too somewhere. 35.1 days. It's taking you that many days to collect your accounts receivable. So now you're already, you're already tying your money up 35 days. Okay, we're going to tie our inventory up before we sell it. Okay. Now let's look at inventory turnover on page 734. Your inventory turnover is cost of goods sold and average inventory, beginning plus ending divided by 2. All right, you got 40. Now divide that 4 into 365. We know that's a quarter of a year. That gave you 91.
91.3.
0.3? All right. Now, if our inventory is sitting on the shelf for 91.3 and we sell it, and it takes 35 days to collect, what does that give me? You don't see your money for 126 days. When you go out and buy that inventory, and you keep that inventory for 91, and then you can't get your accounts receivable for 35, you've got your money tied up for 126 days, which is what? About 4 months? Now, if you would, look at page 734. So that's called operating cycle then, isn't it? They must have got 35. Okay, what that had? We had 35. I rounded off, but 35.1 and 93.3 is 126.4. That's called what? What's that called?
Operating cycle.
Operating cycle. All right, operating cycle. Now, the operating cycle measures the elapsed time from when inventory is received from suppliers to when cash is received from customers. Now, a manager's goal is to reduce the operating cycle. You want that reduced. You want to collect quicker. You want to sell quicker. Now, even though you've had this inventory for 91 days, you might not have paid for it till 30 days after you got it. So you still may not be out money for the whole 126 days. Because you had accounts payable, maybe 30 days to pay. So you'd be only out about 100 days or whatever without receiving some kind of money. All right. So those are activity ratios. Now, total asset turnover. Sales divided by average total assets. All right, I want you to go back to page 731. Now, this is about where we're starting today. I just reviewed what we did Tuesday. Total asset turnover. Now, they did that for 52,000. They did it for this year, right? I want you to do that for last year. We're going to practice as we go. Page 731, last year, give me the total asset turnover. You see the formula? You see this year. Give me last year. Tell me what happened here. First part of the semester, you're here every day. What happened?
Let's see.
Got a longer drive now. Let's see. All right, what's your answer on that one, somebody? Need all of you to calculate this. But answer you, Kayla, what number do you have? What? What? All right. Here's what I want you to do. You take sales of how much for last year? 48,000, right? Now, what are your average total assets? Average is this year. Whoa, that might have stumped you right there. For this year, we can take average total assets, can't we? For last year, we don't have the beginning, we have the ending. So that's not going to work then, is it? If we got an average of anything, we'd have to have the year before last year. Okay, you can't calculate it. All right, but you know how to. Okay, now on debt management on page 736, I know we can do this one. Now, I told you on page 736 to find times interest earned. I said was E B I T over I. What did I say EBIT was, Anna? Earnings before interest and taxes. Over interest, right? Now, they've got it in your book laid out here for you, and the answer is 4.91. Now, try to do this one for last year, since we don't have to do an average. Try to do times interest earned for last year. Okay, what numbers are we using? Bangers, what numbers are you using there? 30 what?
3,900.
And divide that by?
700.
All right, and that gives you
5.6.
5.6. All right, it's just 3,900 is operating income, and that's earnings before interest and taxes. And interest was 700. All right, in your book last year, EBIT or times interest earned was 4.91 of this year. What is better, last year or this year or last year? Which one's better? Which is better, last year or this year? Anna? This year is 5.6. You know that's better than 4.9. Anytime you can earn more, the bigger the number, the better for times interest earned. Okay, your debt to equity ratio is total liabilities over stockholders' equity. All right, your answer here is 0.85. All right, now what does that tell us? Liabilities over total liabilities over stockholders' equity. Some companies believe in 50-50. Finance 50% with liabilities and finance 50% with equity. All right, but here we divided stockholders into equity and it's 0.85. So liabilities are still higher than equity. You know, if this came out 1, that'd be the same. So do that for last year. Now go to your balance sheet. And your balance sheet is on page 730. Has anybody got it for last year yet?
0.81.
Could be, Mark. Let's see, what numbers are you using, Mark? Last year, you're using total liabilities of what, 13,000? And you're using total equity of 15,971. Yeah, equity is more than your liabilities, which is good. You'd buy it the other way, you'd get a 1 point something. But this is equity ownership. Last year you had less ownership. You got more ownership this year. All right, now we got equity multiplier. Average total assets over average stockholders' equity. Now anything with average we can't do for last year because we need the year before last year. But look at that formula. Your equity multiplier is your average total assets over your average stockholders' equity. And here it was 1.83. Now we look at profitability ratios. All right. I want you to look at this gross margin ratio. Now I want to show you two things about gross margin. When you do this on a test, you can see this and maybe don't even have to calculate it. Now your gross margin percentage, did they not even calculate it? Let's do it for this year. Divide your gross margin for this year, back on your income statement, 16,000 divided by 52. I say 16,000. So what is my gross margin ratio for this year? $16,000 divided by 52. What does that give me, someone?
0.30.
Now do that for last year. Real quick, what is it for last year? What?
0.33.
Well, your gross margin has went down 3 percentage points. But I wanted to take you back and show you on a common size statement if it's in here. I think it's in here. Let's see. No, it's not the same statements. But when you do a common size statement, you have those percents. Look at page 728. If I told you to do this gross margin percentage, you've already done it if you've got a common size statement. Here, the gross margin percentage, oh boy, no, wait a minute. They didn't calculate it here. They're doing the horizontal analysis. They're not doing the vertical. No, it's same numbers. All right, go to page 731. All right, 731. Look at those percents. Mark, you gave me 30. Was it 30.8 or? Now, Mark, did you divide 16,000 by 52? 16 by 52. Is it 30.8?
.307.
What?
0.307.
How'd they get 30.8?
Move the decimal point over twice. Maybe 30.8.
It would round off to one. And then Cody, how did you get, it says 34.4 and you gave me 33.
Yeah, if you move over the decimal point, it'd probably be 3.4.
All right.
That makes more sense.
But that's how you get gross profit percent. Net profit margin percentage is net income over sales. Now you can go back and find your answers. Don't need to calculate them now on page 731. What is your net profit percentage for this year? Total net profit percentage on page 731. What is it? 3.4. That went down from last year, 4.7. All I am saying, these percentages are done for you if you did a common size statement. All right, look at a few more ratios, page 739. Return on assets, net income plus interest over average total assets. All right, look at that formula, especially for the tax part of it. Now, you'll have trouble with this one if you're not careful. Net income plus interest expense and then, of course, times 1 minus your tax rate. Why are they doing that? Here's why they're doing that. Now, an itemized deduction in the past, let's say you paid $2,000 mortgage interest and you're in a 20% tax bracket. How much is that $2,000 interest going to save you? It's going to save you $400. So your real mortgage interest expense is the difference, or $1,600. That's what this formula is trying to tell you. What is your real interest expense after taxes? Okay, let's see if we can shorten that in it. The example they give you here is net income is $1,750,000. Your interest expense is $640,000 times 1 minus 30%. Okay, so your real, all right, somebody multiply 640,000 times decimal 70. Multiply 640,000 times decimal 70. What have you got, Mark?
448,000.
Now add that to 1,750,000.
$2,198,000.
Now that's what you divide by your average total assets, beginning plus ending divided by 2. And that will end up giving you 7.3%. But do you see, if your tax rate is 30%, you're saving 30% in taxes. Now, if I pay out $1,000 in interest expense, and if I multiply that times 1 minus my tax rate, I'm multiplying that by decimal 70, and my real interest expense is $700. That's what that formula is showing you, okay? All right, return on equity is net income over average stockholders' equity. Easy enough. All right, another way to look at that, return on equity is your net profit margin times your total asset turnover times your equity multiplier. That's 3 together there. And that will give you the same percent of 10.6. But just do it the first way. Net income divided by average stockholders' equity. Okay, now market performance or EPS on page 740. I have had doctors and lawyers before to take this accounting class. And this is one chapter they liked. They were big investors and they wanted to know all these ratios, return on their equity and investment, and how to invest, price earnings ratio. And they wanted this one chapter in accounting principles. Plus they wanted to know corporations. So that's why they took accounting principles, is to know a corporation and know these ratios for investment purposes. Okay? And here we're talking about the stock market. Yesterday's stock market went way up. But in the month, I guess, of November, October, it went way down. And Bluefield State's staff depends on the stock market for their retirement. Okay. Dr. Sneed said in 1 month he lost 40,000, so he got out of it.
What do you, in a month?
A month. A month.
You got money to secure, you can count that 40,000.
Well, it depends how many years you worked here. If you worked here 30 years, they take 6% of your salary, you match it 6%. Don't pay taxes on it. Like Dr. Biggins, when he left here, he had over $1 million. Okay? He's been here about 30 some years. So he had over $1 million in retirement. Now, if you have $1 million sitting up there in retirement, the stock market goes down 10%, how much you gonna lose? You're gonna lose about $100,000. All right? But my Virginia retirement is different. They used to pay him 5.5, and we paid him 5.5. But it's all based on the stock market.
How much you got?
In Virginia, state of Virginia, I don't have any, but I get a paycheck every month.
I'm talking about here.
I've only been here nine years. I may have 60, 70,000 built up already.
You need somebody else to spend.
Yeah.
Not much.
Do what?
It's like 60, 70,000, not much. Like it. A little bit.
But anyway, it's not much to retire on, Mark.
Yeah.
So, 60,000 is a lot of money. Yeah.
Yes, it is.
All right. So anyway, we're talking about the stock market, and but the stock market went up about 3% yesterday. And Dr. Sneed or anybody else, if I lost 10%, it went up 3 yesterday, I'm only losing 7. So hopefully it'll come back, I'm not losing anything. So you never know about stock market. If you can foretell the future, you'll be a billionaire easy, wouldn't you? Okay. So your earnings per share is your net income divided by the average number of common shares outstanding. Now, if you could earn, this is earnings per share, that don't mean they're giving it to you, right? You're getting 350 earnings per share. That's important for investors. But now, your price earnings ratio is your market price per share divided by your earnings per share. Okay, but the dividend payout ratio down here is 41.1%. They're paying out $3.50 a share. Wait a minute. They're paying out dividends per share, $1.44. Earnings per share is $3.50. Okay. Dividends. All right, they made earnings of $3.50, right? And they're paying out dividends. This is what they're leaving in the company. They're leaving $2.06. All right, somebody tell me where they're leaving that in the company. 2 words. Stockholders' equity. Where do they leave that $2.50? In retained earnings. Okay. Now, if you own stock in this company and you got 144 a share, and you owned 1,000 shares, all right, how much did you get in dividends? $144, right? If you got $1.44, is that right, or did you get 1,400? No. Did I get 1,440, or did I get 144? Somebody put that in your calculator. 1,440. All right. Now that's one way you gain on investing in stock. But I have told you over and over, I bought some Disney stock a few years ago for $19. Now it's selling for $113. It'll soon be 6 times. So I get a dividend from Disney every year, plus my stock went up. So you make money 2 ways on stock. But you can lose money bad, like Dr. Sneed did on his retirement. Okay. Not just Dr. Sneed, it's everybody who had retirement, unless they had it in just cash. Okay, page 742, dividend yield ratio is dividends per share divided by market price per share. So dividends was worth 3.6% that year. Then your book value per share is total equity divided by the number of shares outstanding is $34 per share. Now, investors like to look at all these last ratios. We haven't had a whole lot of time to cover them. Now, please Xerox page 743, have your own copy. Okay, we've got time to work a couple of little quick exercises. Now, I've already given you the problem from this chapter to turn in next Tuesday. Tuesday at 10 o'clock, if you didn't hear me, is the exam time. But you can have to 12, 12:30, or 1 o'clock. There's no time limit. If it's your lunchtime at 10 o'clock in the morning or breakfast time, bring your coffee or your milk and your donuts and eat while you take the exam, okay? All right. Let's go to page 750 real quick. Now this exercise 2, you'll need to look at them from 49. Exercise 2, work those 3 little ratios for this year. Exercise 2, 3 little ratios for this year. All right, what you got for working capital? Anna?
14,680.
Now, did everybody not do what Anna did? Just go find your current assets and go find your current liabilities for this year on page 740, what, 9? And come up with working capital of 14,680. Now, to find your next ratio, your current ratio, you divide your current assets by current liabilities. Somebody divide, what does that give me? 2 point what? 4. And I told you this should be bigger than 2. And you compare that with the industry, you compare your ratios with other companies in the same entry nationwide. Standard & Poor's is one good example. Now, the next ratio is the acid test ratio. And you still use acid test ratio. You still use the current liabilities, don't you? But you divide that into what? Your quick assets. What are your quick assets? Cash and what else? Accounts receivable. Well, we don't have marketable securities in this problem. You leave out inventory, don't you? Some books leave out prepaid expenses. All right? But if we just take cash and accounts receivable, that'd be 13,580. So we'll divide by 13,580, and that's one what? One what? 1 point what? Okay, so that's how easy ratios are if you follow the formulas and you look at the balance sheet and you look at the income statements, which I provide for you. Okay? There's no reason for anybody to make under a C on this exam. No reason, but now some of you will find a reason. Okay, I'll see you on exam day.